Okay, good morning and welcome to the Minervini Private Access Training Room. I'm Bob Weissman. If we could do a quick hand raise to let me know that you are hearing me loud and clear, we'll be getting started. Hope everybody had a good weekend. And also want to welcome Mark Ritchie into the mix. Good morning, Mark.
Morning, Bob. Morning, everyone.
Please raise your hand to make sure you're hearing Mark Ritchie loud and clear as well. And we'll be getting started here with some questions. One thing as a reminder, which actually ties into our first question, Mark, do pay attention to your earnings reports for any names you're holding. We have, I think, 6 for our open positions this week. We do tend to post those, but keep in mind, Mark does make decisions sometimes right up to the last 15 minutes of the day. So particularly if you're not following or paying attention or international clients, do make sure that you have you are responsible for your own positions. Of course, you are your own portfolio manager, so you have to make sure you're on top of things. We do tend to post them as best as we can and with the information that we have in our searching of this stuff, but you don't want to get blindsided by something, and that is your responsibility. So the first question there, Mark, here is, with earnings coming up, how close to an earnings state are you comfortable buying a position or not buying a position? For example, if it's 4 days away, would you still buy a name with earnings 4 days away?
If it's 4 days away, yes, I would definitely. Now, of course, just to Bob's earlier point, you'd be cognizant of when they're coming out. But I've bought them as early as even the day of. Sometimes, if it's a really tight pivot, and I think I might get a cushion. But yeah, generally, the closer it is, the more careful you want to be. And then if I don't have a cushion, I'm either cutting the size significantly or just stepping aside.
Yeah, I think it also matters on the kind of market you have. Mark does tend to watch the earnings season and see, the number of blowups or what have you. And this market hard penny environment that we've been in, especially, has been very challenging for not only having enough cushion with the number of misses, but more importantly, what Mark does have no problem is buying a name the day of. Sometimes, like Mark just mentioned, because with a good market condition, particularly last summer comes to mind, where you had some really easy dollar environment, you had stocks moving up 6, 8, 10% in a day on a breakout. And if you have that kind of cushion, that does allow you to hold through an earnings event, having that additional profit there. So right now, we're not getting that kind of ping action when we have names breaking out, and that would be adding caution to how quickly or being mindful that you're buying a name. Mark just last week bought a name with the earnings the next morning, if you remember, and he exited out that day by the close just because it didn't provide enough cushion. So that's an individual call, but even the same day is not a problem if you can build that cushion.
That's a good point too, Bob, just to add, because Mark was talking about this, if you didn't watch the study session, about how we've seen these institutions are selling into these pops, and the earnings this season has definitely been the same theme. Lots of these earnings pops are getting sold into, even when the earnings prints are good. So that's just a sign that institutions are using that additional strength in even on earnings, even in good news, to potentially lighten up positions or take profits. So we're just not seeing where often you'll see more buying. It's been the opposite.
Yeah, I think a lot of the FANG names, Apple and Facebook and Amazon, all had phenomenal earnings, record earnings effect, and yet the stocks tended to be down all last week. James is asking, when you're doing progressive exposure in a good market, how do you manage to keep your gains before everything comes falling apart? Because by the time you would probably be trading your largest, and bears simply just jump out the window. I think it's just a standard question we tend to get on the progressive exposure, Mark.
Yeah, I don't know exactly what the last part of the question he was referring to, but yeah, how do you keep from essentially, getting scaled up or getting levered up a little bit, and then everything reversing? Well, that's the risk. That's why if you're doing it properly, you're leaning against stuff you've already financed. So you're either, and I gave this example a little bit, almost like sort of stroke by stroke, in terms of how I did it in this last cycle, where I didn't really lose much, and sort of net kind of scratched, even though I got to about 75% invested, and then took it back down to about 25. Well, I had to raise a few stops and a little tighter than I would have liked in order to take the additional risk. And then as everything turned around, I had, to just as quickly raise cash. So it's individualized decisions based on how the positions you are buying are acting. and then saying, if I take on more risk at any one time, am I comfortable with that risk? And if not, where can I make room for it? Well, you're going to either have to take partial profits or potentially raise stops. So yeah, it's yeah, sort of the same answer. And you're not going to get a different answer in terms of progressive exposure. But if the other point is, okay, if I have to scale up and then I scale right back out, if you do it properly, you should be risking roughly about the same amount of capital. But if you get it right, this is where you can start with a 1 to 2% risk and do 5, 10, 15x in a short period of time. That's the power of progressive exposure.
Just bringing up here on the chart VCEL, and Eric just had a question about it, developing a pivot here or not, and is it something we should be focused on or staying away from it? Eric, my quick comment to you would be, it's not on buy alert with Mark, so that's your first sign of it being under the radar, if you will. With Mark, obviously we did own this, we got stopped out on this big reversal day, and if it is going to be resetting up and looking under our criteria of buying, you're going to see that appear on buy alert. But any quick comments you want to comment on the VCEL? Mark?
Well, this is similar to some of the theme we've been talking about, and this actually was purchased earlier. It improved, broke out, and then that same day then failed. It looks like, though, this is sort of, Mark referred to that like crossover, or that leads to a slingshot, then slingshot into new highs. And now it looks like it's pulling in orderly, but then we've seen some of these then break apart again. And this is what just tends to wear people out. Well, then they buy the new high, and then the volatility continues to widen. So I sort of have a little bit of an ire of skepticism on anything, on a lot of things right now. I'm taking it very slow and waiting for a little more confirmation. But it's a 98 relative strength. You should keep it on your radar and see how it acts.
Yeah. David asking, regarding the CrowdStrike trade, should we consider time compression on the weekly time frame? Let's just pull that stock up real quick. Which is a name that we bought here on the 27th. And oops, right here on the 27th. Just talking about the rise from the lows, up about 35% over those 4 weeks. Question if he's asked, is this a compressed kind of right-hand side, is what he was asking.
Well, I would say let's look at the daily too, but CrowdStrike was a former leader, has really good fundamentals. This is in that computer enterprise software group, and it was really just trying to put it in a cheat area. This is buying through the cheat with an acceptable stop, sort of similar to the PayPal setup, which we got knocked out of today. It's the same kind of theme, but as Mark had said, some of these are failing, meaning we're seeing some of these cheats sort of proliferate, and in the growth areas, whether it was Uber, whether it was Lyft, CrowdStrike, PayPal, they're just not working. So yeah, I wouldn't say it didn't work because of time compression, and I think the pivot is fine. It's just we're not seeing any follow through in these breakouts, and this may reset. It hasn't completely failed yet. This looks like it's trying to put in a bigger base, so it may need to undercut and then rally back up and tighten up again.
Hey Bob, can you hear me?
Yeah, Mark, how are you?
Because I'm actually on my cell phone. I'm not in front of my desk. I'm in the office, but just not in front of my desk right now. So can you actually hear me with the cell phone?
Yeah, sounded good.
Okay, so I'm listening to you guys. Just real quick on CrowdStrike, I have to admit that I think looking at this, I think this was a bad buy. I have to say that I made an error on this one, and the reason is when you talk about compression. Now, look, if the market was good, this thing certainly could have ripped right up the right side. And me looking to kind of trade these things, I've just been trying to play it from every conceivable pivot point and just hoping to get some moves here. But we just tried everything under the sun here. I mean, and nothing is really working other than just these really short-term pops. So it's, again, to get those short-term pops, you can trade up this right side. But if you take a look, the 50-day, you see how the 50-day is in a downtrend? That's really where I generally will avoid that, unless I think the stock could run up and then it's going to hold its stop and give it time to flatten out. And it was close enough where it could have worked and maybe run up to the old highs and then built the right side, and it would give that 50-day time to turn around. But under most conditions, you should probably just stay, have a general rule to try to stay away from stocks that are coming up that right side and they're diverging from the 50-day. I say this all the time, but I sort of broke my own rule here. Maybe thought I tried to get a little cute here, and hoping it would just rip. But again, I have to say that this one, and when I say a bad buy, I also think that probably should have just on this one, if it didn't just go right away, just get out. But I have to tell you guys, I'm going to be honest with you. I'm always honest with you, but I'm going to just tell you right now again, with this particular situation, when we're getting stopped out, if I tighten up my stops. When I'm not doing well, I tighten up my stops. But I'm going to tell you right now, everybody quits when we start tightening up. When we start getting stopped out a whole bunch of times, and then we tighten them and get stopped out even more. Everybody's like, oh my God, there's a whole bunch of losing trades in a row. Yes, but that's the whole idea. You're not supposed to be in there trading them all or trading them with size if they're not working. So, again, Mark, if you're getting hit, clipped stock after stock, are you widening your stops?
Of course not.
Of course not, right? So, but the problem is that we have to teach you, and you're a lot of you guys are just running in there, just buying and buying and buying and buying. No matter what I say, no matter how many times I pound the table and say this market's not good right now, we're going to show you the setups. We're going to highlight them. We're going to highlight them. We're going to show you the setups. Last week I'm trying to show you how incredibly risk adverse I am right now. And look at FedEx here. I buy a piece of FedEx. It just jumps up. I think the first it was up a point, then it went up 2 points. I sold 75% of my position. I financed my stop. I widened it a little bit. I started off at I think it was like a 1 point stop. I ended up financing it to a 2 point stop. Now, if it moves up a little more, I'll sell more. That'll give me more, cash that I took out of it. That I'll finance another stop. So now I'm free rolling the trade for a bigger move. Now I'm only going to have a small position when it's all said and done. I'm going to have a little position, a 5% position, but I'm free rolling. I got a free 5% position instead of taking that initial big position and shooting for the moon. And then I get stopped out again. And now another loss and another loss and another loss. And I'm racking them up. Instead, what I'm doing is I'm just chipping up, building the kitty, building the kitty, building the kitty. My kitty's built up pretty big now. I've been killing it with short-term trading. So now I've got a lot of latitude. So now what I'm doing, now I have big profits built up. Now I'm saying, okay, I'll play some of these things for bigger moves, and I'll go for break evens now. So now I'll take that. Before I was taking the short-term profit and just taking it. Now I'll take the short-term profit, keep some, and then use that to finance a stop to try to play it for a bigger move, see if they can start working. If they don't, well, then I break even. I still maintain, the integrity of my equity curve. So I know I'm digressing here and going off, but I'm just trying to show you how two things. One, just answer your question on that as far as the compression, and also just talk about how, look, I make mistakes all the time. I constantly make mistakes. I look back and say, okay, I could have done that better. There's no way to get this perfect. I mean, every now and then, you get it just right, but you're always making mistakes. I make tons of mistakes. I just don't make grave errors. I don't make big mistakes. I never make big mistakes. I correct them very quickly, and you can see how I operate. But this is something where, you really have to be, very careful in this market here, and not just, looking at the stocks that we're putting as buys. You got to take it in consideration, and also what I'm saying as far as exposure. So you could be buying a lot of, again, Mark, what do you invested right now? What's your percentage invested?
About 20.
Yeah, see, he's 20% invested. See, things aren't working. So he comes right down to being very little invested. So again, he's playing some of these names, but if he gets clipped, a few times in a row, he's not really losing much money. He's not going to step it up until he's getting traction. You're just going to see that over and over. So this is where I kind of wanted to segue back to this to make sure that, those of you that are new aren't just going in there and buying like crazy. All right. I go back to it. I'm going to listen to this though. I'll be listening.
All right.
All right.
Next question is on Zeus, which Mark references one of the names that is acting well. today in particular. And the question from, actually 2 questions from David and Carlos is if you could review Zeus, if that's considered a proper base and pivot because it looked like a jagged base with many down days. Then the last couple of days we're closing in the back lower halves of the trading range for the days. And another Carlos asking similarly, what would be the proper buy point of 29.79 or 29.97? And I think that's just a difference of, whoops, let me just get out of here. The pullback buy entry here, right? The high of yesterday or the high of the pivot here. Nope, 29.97 was the high of the prior day.
Yeah, well, this is a power play. So there's your, if you haven't read that section of Mark's books or been to the Master Trader program, I mean, this is sort of the textbook action in terms of you have stock that's doubled in a short period of time, and then it doesn't give much back. I mean, let's look off the highs here. You got, the high at 331, pulled back from 32 to 26. That's right in that sort of less than, 20-25%. And you kind of have 2 little tightenings here. Bob, you can draw those in. The 2 T's, as you call them. And this last one was really tight and volume came down. So I had an alarm on this as well, and I'm watching this. This should work. I mean, especially with this type of a breakout, I'm very interested to see, does this hold or not? And as far as buy points, yeah, you could have. Normally, I would buy a little through potentially Friday's high, the 29.79. And this is where you can stagger your buys, just like you stagger your stops. Buy a little through 29.79, then you can bump the position if things are working through the high of 426 and that 30.70 area. I mean, that's really the sort of your cheap pivot. But this is up double digits today. If this just, again, squats, gives it all back, takes out the low, that I'm looking for a sign of character change. This is going to be an example even for me where I'm willing to take this pitch to see, is anything going to change? And not just today, even where maybe it holds today, and then we've seen these in the next day or 2, then just completely blow up. So if you didn't
good
buy
point,
it,
Mark. Yep, good point. Yeah. Hey, Mark, did you buy any of this?
I didn't.
So let me give you guys a little clarity as far as how I handled this, and to show you that I'm even gun shy a bit here, because normally on a stock like this, I would buy it as it was moving through that pullback buy. All right, I'd probably start buying it as it got through the previous, days higher, and so that pullback buy before it went through that pivot. That pivot that I'm talking about, Bob, what is that that high there, right there? It says,
30.70 area.
yeah, so that's the pivot. That's when it actually moves to the pivot, and that's the buy point. But I would usually start buying it as it moves to the pullback buy, and then add to it if it can get through that pivot, and just sort of build my position in. So, but today I didn't start buying it as it went through there, and then I hesitated, and then it started going through the buy point, and it was moving so quickly I didn't want to pay up for it. So then I said, well, I got to at least alert everybody, show them. So then I tried to buy some, and I got 1,000 shares. So that's all I could get was 1,000. And something like this, $30, I'd be looking to buy a lot more than that, 10, 20, 30 times that amount. So I only got 1,000 shares on, and then I just, when it was up, it was up nicely, 10% or so, I dumped it. That's how I played it. And like I've been telling you guys, look, if you can get 5-10% move in 5 minutes, that's pretty good. That's pretty good. So, and again, with this, probably with a power play, I should be playing it for a bigger move, but it was just such a small amount of shares. Now, if I got a big position on this, if I was able to get in there and I had a good sized position, and then it goes up 10%. Oh man, I'm going to take off, good, just like I did with FedEx. Well, this would be a much nicer situation. Take that, maybe, half of it off, or 75% of it off. And now I got all that cash to finance a full stop and let it go below the pivot or below the low of the base. And it's a free ride. It's a free ride, So if the stop is 8%, and the stock goes up 8%, if you sell half of it, you now fully financed your stop on half the position. It's a great position to be in, right? So that's if you time them right and they take off like this. But this looks great right now. But as Mark said, how many stocks start off looking great, and then by the end of the day, this complete reversal, right? down for the day, engulfing the low, or the next day or 2 days later, just gives back everything. So that's the character change that we have to see. Until you see that character change, you got to stay with just the trading the short-term pops.
All right, let's go on with quick question from John asking about WES, thinking that was a good VCP. Quickly asking what was any thoughts on this and entry above that 1970 price point. Let me just see where he's showing.
Yeah, I mean, you can draw that in, Bob. You had a nice little VCP cheat area there.
Yeah, right.
It was potentially viable there. For me, this is looks like an early turn in terms of the long term. And it's also in the oil group, which isn't really one I like to participate in, but I think your eye in terms of spotting the little pivot area is good.
Yeah, just trying to help people to see breaking out above this little pivot here. Question to Mark Ritchie: when you get started trading, how do you train yourself up in terms of executing a trade, like buying only when bids go up, monitor breakouts and on the watch list, setting stops based on technical areas on an intraday chart, putting on overweight positions? Jason's asking these questions.
Basically, how do you become a good trader?
Yeah,
that's sort of what it sounds like.
Well,
Well, listen, the first thing you have to understand is it's going to take some time. So he mentioned a couple different things, recognizing maybe that bids are going up, or how to maintain watch lists, how to set good stops in certain technical areas, or identifying chart patterns. Those are 5 different things that you're going to improve on with time. And I know everybody wants to shorten the learning curve, and the question I get from people all the time, especially when we used to do in the in-person master trader program, how long did it take you to get really good? It's like, well, I still don't feel like I'm really good. I still feel like I'm getting better at this all the time. Because like anything, the more charts you review and the more pitches you take, the more the more proficient you get. So, to be realistic and say, I'm going to be committed to really getting good at all these different areas is going to take some time. So, and then listening, what's going to affect it more than anything too is who you listen to and who you surround yourself with. So this is why for a decade I was still I read, this is before Mark even had books, but was just listening to the same kind of stuff. You need a good coach in anything. The best athletes in the world have coaches. Well, and some people that have never played sports don't understand, why would Tiger Woods have a swing coach? Well, because he's always trying to refine and have another set of really qualified eyes watching what he's doing. And that's kind of how I view this.
Real quick, I changed. I'm back in front of my desk here. Is that a better sound?
It is
Yeah?
definitely.
Okay, I'm on my computer now. Yeah. So Mark is humble, of course. You are really good. But yeah, he's very humble. Yeah, man, we're always feeling. I've been doing this for 37 years, and I still, I'm learning. I still learn every day. So it's a work in progress always. But look, just one quick thing I want to say. I don't think we can shorten the learning curve anymore. I really don't. I think we've got it down to where, with our curriculum, with this type of platform, and certainly with the Master Trader program and the books that I've written and O'Neill's books, I really don't think you can really compress the learning any tighter. I mean, now it comes down to experience. You get all the information. It comes down to experience, and that just can't be forced. Like they can't rush that.
Yeah, I happen to have just the benefit of working with thousands of people who have come through this process with us, Mark, for the last 12 years. So I really do have the benefit of knowing what it took for thousands of people to go through those learning curves. And the feedback I get consistently is sort of what validates that the process that Mark developed of how to go through this learning process, being on the platform for a year, going to the Master Trader program, of course, reading the books, watching the trading tutorial videos, takes still about a year, even with doing all that. But that is, I mean, think of a doctor, a lawyer, an accountant. You're talking about multiple years to become even qualified as a in those
Yeah.
professions.
But
Here,
it takes about a year just to get a real understanding.
yeah, exactly.
You know, we've
You
got
get to-
people that have come to 5, 6 master trader programs, been on this platform for a decade, and they'll say to me after 5 years, "Wow, I just really got it." You know, I mean, I said I just really got it. In my first 5 or 6 years, and then 10 years later, I said to myself, "I just really got it," and then 10 years later, I said, "I just really got it." So
Yeah,
you'll keep saying that for decades, believe me.
yeah, and then that's a good point, Mark, because I've been with Mark for about 17 years now, and the one concept that I might have taken a few years to get, I got, and then a couple of years later, I'll get another major concept, and each one of those things just keeps adding to it. You just keep improving over and over. David is asking on the platform, we have swings. Mark is identifying the maximum stops now, and that's based on swing trading. But obviously, if you're using shorter term timeframes, you have to tighten those stops. So he's basically asking what would be the typical stop that Mark would be using on the shorter time frame. I think the 2-to-1 that Mark is maintained throughout. Right, Mark?
Yeah, but that really has to depends on, how short of a time frame. I mean, if you're day trading, if you're looking going into a stock and saying, "Hey, I'm looking for a point here." Well, you got to think, you have to look at what's the probability of that trade working out. And then your loss obviously has to be less than a point. If it's 50-50 or, whatever that number is, you've got to do the math. But you should always be looking at a 2 or 3-to-1 reward to risk. Always be looking to get, odds on your money, 2-to-1, even if your batting average is high, because day trading, you can have a higher batting average. You generally will have a higher batting, and I know everybody, but some, I know, friends of mine that are day traders, they have a higher than 50% batting average, but I would still go for, try to keep it at 2-to-1.
Matt is asking on the NARI, which I have up here showing, did that qualify as a breakout on Friday the 30th? And if not, could you go over some breakout characteristics to help spot true breakouts? And I got to remind you, I think Mark did actually have a note on Friday about NARI as being in a better market, or typically this would be a name we would be looking to be all over. But Mark, can you take a moment about NARI?
Yeah, if the market was really acting well and everything was breaking out and holding, I probably would have bought that as it popped its little head out there, and it probably would have kept going and held up, and it probably have a better chart than this. But I have to say, you see the 50 days flat trending down just a little bit. That right side is a little bit compressed. Optimally, it could build out a little bit and it could drift down. It would be nice if it came down here a little bit. You had that 1-day shakeout, which is nice. But I would love to see it drift off a little bit here and tighten up even more. We'll see if you get that. Sometimes you just don't get them perfect. They'll go up that right side. That's why you have to really gauge it. And my general rule of thumb is that when things are working, I get more forgiving, and I'll start buying short right sides, and I'll start doing things that maybe, are given the benefit of the doubt. But now when things aren't working, then I'm being much more of a stickler on it. And even if I am buying them from these, where I'm giving them the benefit of the doubt, I'm going to take smaller positions, or I'm going to try to finance my stop, and I'm going to do it from a much lower risk, angle. But to answer your question here, yeah, that was a breakout. It tried to break out. I don't know if it got above that 1641. That was the high there on the left side.
Not there. It did break out above this pivot, right? Right.
Okay, so yeah, so it's still in the pivot there.
Yep.
I'm watching this carefully. I'm interested in this. I love that big giant move that it had off the lows there and just ripped right into new highs. Yeah, but no, right off the lows there on earnings there.
I'm sorry.
Yeah, in March.
Yeah.
Right there. Look at how it ripped. I mean, that's what you want to see. And then it comes in and it starts just tightening up here and it's digesting. So that's really, when you see that kind of volume, that kind of move ripping up like that, and then it tightens up, that should break out and hold. Like if that breaks out and it can't hold and you get stopped on that, I mean, that's just so abnormal that it doesn't make sense with the accumulation that you just saw on the left side of the base. So again, how is the train coming in on schedule? This is how you dissect the base and look at the quality of the base.
A question from Adam, Mark, is when you're screening, are you looking at the daily first, then the weekly, or vice versa?
I look at the daily first and then I look at the weekly. What do you do, Mark?
I look at both. Yeah.
Yeah. You're screening on the daily first?
I just have them. I have them done together on the same screen, but yeah, I would say my eyes are probably 80% on the daily.
Right. So wait a minute. On MarketSmith, you have them together?
Well, I'll have it where I just open up a weekly chart in separate screen, but it's pinged to
Gotcha.
the same chart, so it brings them up together. You know what I mean?
They update together at the same time?
Yeah, on two different screens.
Well, how do you do that? I'm not sure. I've been trying to figure out how to do that for the
Like you
longest
said,
time.
I guess see, Mark's still learning.
See,
Right.
I'm learning today how to use MarketSmith.
Yeah,
I think it's
I've only been using it for 30 years.
Right here, Mark. See how you click this button right here,
Yeah,
and it pulls up. Well, I don't have it.
but that
Whatever.
that gives you a regular chart, like a bar.
no, go to the one next to it, Bob. I would go to that one there,
Oh, I'm sorry.
And
I
then-
hit the wrong one.
and then hit whatever time frame you want on it.
Yeah, this would be the
And then,
weekly.
and then if he changes the symbol on the other one,
Then if I
Okay, I
go,
see what
then
you're
check the
saying.
box. Check the box on that though that says it draws it from the original
Yeah,
oh,
screen.
right here, receives right here, Mark.
Yeah, receive symbols from main chart, and then
yeah,
so-
because we've made this suggestion to Arusha for years now.
yes, I know. Yeah, right.
And David Ryan has been, making a suggestion for us to be able to actually put up, like maybe 4 charts or 6 charts to be able to screen and see a bunch of them in a bird's eye view. And also, so yeah, I look at the chart when I see something I like. I write the names down from the daily. Then I go back and all the names that I like on the daily, I go back and I look at all the weeklies. So I kind of do it in two. I might just flip over to the weekly. I click from daily to weekly and look at it real quick. But once I find the stocks that look good on the daily, then I get in. I look more in depth into the weekly.
Yeah, I can't with my projection screen. I can't show you how they're updating instantaneously, but they are toggled together with this
gotcha, yep.
checkbox right here. Receive symbols from.
Oh yes, I see. Oh, okay, right. Yeah, I did not know that. I did not know that you can do that like that.
Next question, Elliot is asking. Mark mentioned earlier he waits for people lacking discipline to get frustrated. Would be interesting to hear what you think the market would look like if everyone had read Mark's books and applied these principles with discipline.
Well, if every single person was doing the same thing, obviously it would invalidate it for that, for that time where if every single look, first of all, that's not going to
It's
happen.
never going to happen.
It's never going to happen. So, I mean, I don't even know why we're going to talk about this, but
Well, that's like saying
we'll waste some time and we'll talk about it.
well, it's like saying, what if everybody read Arnold Schwarzenegger's Encyclopedia of Bodybuilding?
Yeah.
And looked like him. Do you really think that's going to happen?
Yeah,
The
it's
amount
not
of-
gonna, it's not going to
just
happen.
Human nature. It's impossible.
And even if it gets to the point where a particular style or technique gets popular and it gets too popular, let's say, that's exactly what I was talking about on how that's precisely what will get it to work like a charm again, because then, okay, so now let's say it gets invalidated for a while, it's not working for whatever reason, then people abandon it. And so it's going to ebb and flow. Nothing's going to work in perpetuity, and you're not going to be able to, no. And again, these patterns don't form because of your because because you see them and they work. It's not the cause, it's the effect. You're seeing supply and demand on display. Much of this is being made by institutions. The majority of volume in the market is institutional volume. So we're talking about retail, more retail buying. When you start getting something very popular and it gets into the masses, then it can create some noise. But that's short-lived. It's short-lived. This is you don't have to worry about a strategy getting invalidated. This has been working since the late 1800s. It's not going to change. It's not going to change because, like I said, it's not the cause, it's the effect.
Morale is asking, in your experience trading thinner stocks, does it have a positive expectancy trading stocks with less than 100,000 shares or under $10 a share?
Again, guys are always looking for these black and white answers. I know, so the question is there more of a positive expectancy?
Yeah. Do you find trading thinly traded or smaller cap names more profitable?
The opportunity, look, it's simple supply and demand. Okay. And it's simple. Just think about it. If you have a stock like Coca-Cola that has 60 analysts following it, how inefficiently priced do you think that name is compared to some company that has 5 million shares in the float and is followed by one analyst and nobody's ever heard of it? Obviously, the smaller name is going to have a much more likelihood of being inefficiently priced. That doesn't mean that small names go up more than big names, generally speaking, but if you do your research properly and you're applying these techniques, your opportunity is going to be in the small names. Now, there's periods where we've had a mega cap boom for a while. So it's not, you can't just say blanketly and say that, just stick with small cap names or smaller floats. But the research says that the biggest winners, you go back, you can read O'Neill's book, you read my book, you can go back and if you can find Richard Love's Super Performance Stocks, it's out of print, but you'll see that it's consistent throughout the last 100 years, that the smaller names are the one, or is where the opportunity is. The biggest winners generally have smaller floats and then the smaller names. And again, Amazon was a smaller name. All these stocks that you're seeing that are I could assure you that Amazon is not going to make the move that it made in the last 10 or 20 years, in the next 10 or 20 years. That's done. You have to look forward now and find the next Amazon. I was buying Amazon in 1997. Walmart was trading 500 shares a day in the 80s. That's when the opportunity, that's when it was there, when Sam Walton was standing on a soapbox in front of the store trying to get people to come in the store. Now that's gone. Walmart is not a small cap name that is inefficiently priced. It's almost perfectly priced now. There's going to be times where it has inefficient price moves, but generally speaking, you're going to have, a very random stock that's going to be very hard to make big money in.
Real quick question. Jason is asking, at the MTP last year, you mentioned that you don't like regional banks. Can you just explain what's your reasoning for not liking banks or regional banks?
It's not that I have a personal disliking. When I say I don't like, I don't trade the banks too often. The regional banks are, they just haven't been an area that I've seen that work as well and respond to these type of tactics, along with the cyclicals, deep cyclicals. I know, Zeus right now, steel, that's definitely a deep cyclical, but there are occasions, but when you go back and you look at everything I do is science-based. It starts off with looking at the facts and looking at the science behind it. Then, of course, there's the art side of it and the trading part, where now it's techniques and skill and art and so forth. But it all starts with science. And when you look at the science, and when you look at the groups that have the biggest winning stocks, there's 70% of all the biggest winning stocks are in only about 5 or 6 general groups. And I've showed you guys that many times. It's the technology, computer, software, medical, biotech, medical related drugs, leisure and retail, retail, consumer retail, leisure and entertainment. And then there's telecommunications and some financials. But the banks, and you look at the banks and the deep cyclicals, commodities, steels, papers, they're not in there. There's periods where they do well, but that's not where you generally find the biggest winning stocks.
Scott is asking, after reading Mark Ritchie's father's book, My Trading Bible, with our style of trading, the been reading style, what extra risk precautions would you say we should take? How many losing trades in a row is realistic with our trading style? And after how many do you reduce risk per trade, or do you link it to your P&L decline?
Am I supposed to take that one? Well, I'll say, listen, you don't need extra risk precautions. The same idea of progressive exposure is exactly what somebody like my dad preaches. If things aren't going well, you have to reduce your size, because you're going to have periods or losing periods that aren't normally distributed. Meaning, let's say you're a 50-50 trader. Everybody thinks that, it just goes heads, tails, heads, tails. That's not how it works. If you run random number distributions, you'll find you might have 50 tails in a row. Now that'd be a big outlier, but you could certainly have 10. I've had 15, in terms of losers in a row. Well, so after which number then are you going to start drastically reducing? Now, after a few, that's when I get my antenna up, which is why I've been trading small for months. So it's the idea though of saying you have to understand that, you're going to take losses, and the only way to keep them from becoming financially and emotionally destabilizing is to trade smaller when you get in those periods.
Financially and emotionally destabilizing. I like that. That's an accurate description. Yeah, and it also is a combination of, if let's just say you're trading pilot buys and you're taking tiny pilot buys. Well, and there's times where I go in and I say, I don't like this market here, or I think it's risky, and I go in and I buy a liquid stock that has a penny spread. I try to time it perfectly. I take a big position and I put a nickel stop on it. And if it goes against me, I'm out. If I time it perfectly, bang, I'm at a profit right away. Great. I put a break-even stop, or a very tight stop, and I don't take much risk. I can take a bunch of those losses. I mean, I could take 10 of those in a row, and what I lost I've lost a half a buck. So it depends. It depends on what your risk is. It depends what your position sizing is. That's, it's like I said, it's not a magic answer. There's an art to this, and there's some style to it. And you've got to make those decisions in real time. So, again, in this type of market, you see what I'm doing with something like a FedEx, nice big liquid name. I'm going in there with a real tight stop. I can make these trades. I can make lots of these trades. Like I said, I've traded Ford and GM and that Goodyear tire, some of these big names that have literally penny spreads, and taken these giant positions in them with very, very tight stops. I would never, put this on the platform and say, go in with a nickel stop, because they stop you. I get stopped out sometimes 8, 9 times in a row before I get it right. So, but then I get it right, and I make a few bucks on the trade. I finance the stop, I play it for a bigger move, and it all pays for itself, because I'm doing the math. If you take one penny stop, which is pretty, that's not really doable. That's too tight. But I'm just saying, if you do the math, if you took, or let's just say a 10-cent stop, if 10 stops is $1. So you have to ask yourself, all right, so what is it? $1 times 10 times the shares that I'm trading, what does that equate to? If you back into the risk and the share size, you could make it where you have 10 tries at those trades, and it only equals one full stop, right? Because your position sizing, or because of how tight, that micro stop is. So I know, again, I go on these tangents and I go way off course, but just trying to give you guys as much ammo as possible and information to be able to understand the concept of risk management.
I just want to add to that too, Mark. He was asking, we didn't really answer. He just to be specific, how small do you go? I think was the last part of the question. I would say I get small enough to the point where I don't trade. I just sort of take a few pitches.
Yes.
This Zeus is a good example. I just said, all right, well, I'm not going to take it, but I'm going to watch it as if I could have taken a 1% position, but at some point they get so small where I just go, I'll take a few and then just see, and then I'll start ratcheting back the other way.
Zeus is a perfect example. I mean, I come in today and Zeus is literally in my crosshairs. It's like, that's the one stock that last night I do, visualization. I do a little morning session and sometimes a night session before I go to bed. I'll literally visualize and go over my stocks on my list and visualize, how I'm going to handle them and what I'm going to trade. And I just kept, in my mind, Zeus was the one today. That was the one that could pop, power play, perfect little pivot here. I'm like, this is the one I got to get on. I got to get on big. And here I come in this morning and I end up with 1,000 shares. You see, it doesn't always work out, but it's purely from a risk management standpoint. And, the stock's up 4 or 5%. I don't want to chase it, and, again, you look back and you go, okay, that was a mistake. Well, no, it actually wasn't a mistake. I actually stuck to my plan. I didn't chase the stock. I didn't take excessive risk. I didn't get on, right when I wanted to. So I'm not going to chase it. Just like I tell you guys, don't chase it. And now the stock's up, 13%. But, I'd rather miss it. I'd rather have a small position and then have a big position and get clipped because I chased it up extended or I didn't follow my plan. So again, I
Couple-
know I'm going off base here, but it really is individual, and you've got to make those decisions as you're trading of what your comfort level is.
Questions here to rattle through. Mark, you mentioned on your overnight session, you something about 133 trades. The question from Tony, is that in a week's time or a month's time?
That was 1 week.
Okay.
Yep, that was 1 week.
Daryl asking, helpful to walk through some of the recent trades, maybe doing some session or some post-trade analysis at times. That would be where helpful to discuss some of these that are being looked at, especially.
What was the?
market.
I don't understand what you said.
He's making a suggestion if we can do some post-trade analysis where you go through some of the previous trades and do some analysis on those trades.
But I have. I'm going through them in real time. What do we post analysis? I'm telling you blow by blow what I'm doing. There's no reason to look at post analysis when we're looking at them in real time. Look, I'm trading. I'm not going to go over all these little, like you saw, I took like 30 losses in a row that were, you saw the equity curve, how it came in a bit, down maybe 0.5%, all those little losses in a row, all these little short-term trades, jockeying for position. We're not going to go over that. I'm not teaching day trading. All right. I think I've already gone off course way too much because of this damn USIC, which I almost wish I never went in, because now I moved into the short-term trading and this is the topic now. So, but bottom line is that you're buying from the same charts. The only difference is you're selling into strength early, quickly, whatever that, if your stop is, you again, that number has to be individual, how much you're risking, and take a look at what's going on in the market here. So we're getting these pops that are going up. Here's a perfect example. Zeus is up, a nice quick move here. This is one that you could look back, you can hold it, and then it comes crashing in, like Mark says, and you'll be wishing that you sold it. And you don't sell it, or you do sell it, and then it goes higher, and you'll be wishing you held it. Look, you got to have a plan. You got to have a plan. So we can do some post analysis. Yes, we can look at the short term, but we've done that. We're going over that, and we went over HPE, GT, a whole bunch of these names. I just told you exactly what I did with Zeus. We just did post analysis. I bought the stock this morning. It started moving up. It went a little too fast. I couldn't get any size on, so I only got 1,000 shares, and I sold it right into strength. That's it. Stock goes up 10%. Boom. I don't know what my net exactly percentage was, but the stock was up, I guess, about 10% or so when I sold it. Gone up a little bit more since then. It's pretty basic. Buy the breakout, sell it into strength. If it only goes up, a small amount, well, then obviously, it's not going to pay for its risk. And maybe you want to even break even. If it doesn't move, you put a break even stop, or you get out very quickly. Your stop is going to have to be tighter to account for those smaller gains, though. But there's no magic here. There's no like special setup or special intraday chart I'm looking at, or the 1 minute, I'm looking at the daily charts. You look at Zeus here, it moved up. The 29.79 was the previous day's high. That was the pullback buy. And then it moving above the 30.67. That's the pivot. Those are the buy points. The buy point is exactly the same there for a short-term trade as it is for a swing trade. No difference. And I'm showing you how to combine that and to take that position. And then if you get at a good gain, a decent gain, and a decent gain, if your stop again is a 0.5 point, a decent gain is a 0.5 point, because that will finance your stop, right? So again, a quote unquote decent gain is a subjective. There is no magic number. It depends on what your risk is. And that is a personal decision. Your position sizing, your risk, all that. There isn't a magic number. I can't tell you this is the perfect number to apply to every stock. It just doesn't work that way. This is what we're dealing with here. You've got to make some decisions on your own and learn how to manage the risk versus reward. Again, I know I'm going off track again. But.
Ben is asking, when you're looking at the weekly charts, Is it that you're looking just at the for a bigger time frame, or is there some other characteristics you're looking for that you're not seeing from the daily charts?
There's other characteristics. I'm looking at the price and volume. I'm looking for the quality of the base. Yeah. I want to get multiple time frames. I'm looking for as much information as I can get to see if the stock is under accumulation and if supply has stopped coming to market, so I can get a low risk entry point with the potential of an explosive move. That's the whole key. The whole key is to get in the position. Look, the whole goal of what I do is to buy a stock and to know very quickly whether I'm right or wrong. I want to get stopped out immediately, or I want to get at a profit immediately. I don't want to sit with dead money and sit around for 3 months where the stock does nothing to then find out that it's a loser. If it's going to be a loser, I'd like it to stop me out today. Right? If it's going to be a winner, I'd like it to move today. I want it. The timing is the key, because time is money. So if now I can move into something else. If it's not working, I free my capital up and I move it. That's the whole advantage of stock trading, is liquidity and having so many opportunities. Like, imagine if you were a real estate investor and there was 10,000 houses per day that you could choose from, and literally every single day you can buy and sell a house at the click of a button. Well, people be trading houses just like they day trade stocks. That's what would happen if you could do that.
Sure.
Right? Yes, but that's not the case. It's a much more lengthy process. There isn't that kind of liquidity. Well, with stocks, you have that liquidity. So you want to take advantage of that liquidity. That's an alert going off on NARI, which let's see what that's saying here. Okay, so see, I have an alert set at a little higher price here. So now NARI just hit that and gave me an audio and visual alert here. It's on an outside day right now. I'm probably not gonna, even if this breaks out here, I don't know if I'm gonna look to buy this. See if like right here with this outside day and really, not having that right side really build out here. I mean, I could buy a little bit here. This is like a situation where, all right, maybe I buy a little tiny bit of the stock here. If it works, great. I got a small position. But if it's not perfect, I might not buy a lot of stock here. So, but I have it on an alert here. It just hit. Now it's pulling back a little bit.
Question on a pause pivot. Brian's asking the example of TXG I have pulled up here being on April 23rd, which is right here, highlighting the volume as well. Would that be the pause pivot? Can you go over the requirements for a pause pivot?
Yeah, hold on, I got to bring up your screen because I'm on my screen. I'm not even looking at your screen. So we're looking at TXG, which I don't like today's action, but drifting down and having a shakeout like this is okay. And now it needs to tighten up more. But today, obviously, it's taking out the low and the pivot. So the question is, what was the question? I'm sorry.
On this 423 day,
yeah,
that being a pause pivot, can you just explain the requirements for a pause pivot?
Not really a pause. I mean, it really was. That's compression right there on that right side in the pivot. So that's probably why it failed and came back in, because it ran up a little fast up that right side.
All right. So could you share what would be the requirements for a pause pivot?
Well, again, the requirement is just 1 day pausing, but you maybe want it to be a little tighter. It's visual, like David Ryan always says. It doesn't have the look. Again, this isn't something that we can computerize. And we can. It really has to. I have to see the situation and take a look at it. But that to me, doesn't look like a pause pivot.
Generally, it's an inside day, right, Mark?
Generally, it's an inside day. Yeah.
And
Yeah.
the
It should
volume
definitely
would
be an inside day.
And the volume would be a little lighter than average, or
You want to see the volume to really, really dry up. Let me see something here no, I was just looking at FIV. FIVE is building a nice pivot here. And I know I'm gonna move off to another stock here for a second, but I'll come back to that if you want, the pause pivot. But FIVE is getting real tight here. And again, if you just look at where it's setting up, once it comes out of this tight pivot, it's going to clear. You see all those reversals? So a whole bunch of reversals there. It looks like there's supply right in that 205-ish area. So once you start coming out of there, you're going to clear everything all at one time. You can be very explosive. I think if the market holds up here and stocks start breaking out, 5 could come out of here really strong. Now you still have all that supply, and it could fail miserably. That's why you have to wait for it to move and not anticipate it, and make sure the volume is really drying up in that pivot, because that will give you that indication that that supply stopped coming to market. So far, it's looking pretty good. You see, it tried to come out. We tried some of these names, of course, and it's been a lot of back and forth, but it's tightening up even more. Sometimes you buy one of these names and then you get knocked out, or maybe you're still in it and it gets better. You're early and then it tightens up and it gets better. But I'm going to go back to the pause pivot. I'm trying to see if I can find an example of a pause pivot. So a pause pivot that I'll show you a pause pivot, VAC, and I'm not sharing my screen.
I got it.
Better if I shared my screen, because I could zoom up a little more. Let's see. So VAC, now this did not go inside, but you can make a case for a pause pivot one day to the left there. No, to the left. You don't know your left from your right, Mom? One to the right there. Yeah. On 422, that's a pause. I would rather see that go inside the previous day. That would have definitely been better. But you got a little reversal there. You can use that as a pause pivot. But again, that's not perfect, and probably the reason why it didn't really work. And now it's still building that right side. I don't know if I can see any other ones. Let me see if I can find another one.
We haven't had many that really worked lately, but yeah, no, I'm looking as well.
No, it's really, looking at something like maybe like a PayPal also on 427. You had that one day. It didn't go inside also, though. The next day broke out. Now it's 3 lower lows coming in here.
Yeah, closing on the low of the range as well.
Yeah. So, look, and I just want to go back to the market here. This market for swing trading is horrendous. It's one of the worst that I've seen in many, many years. But we've known this now for a long time. There's been months that this has been evident. And I've been saying short-term trade. And you guys are going to just keep seeing me make money and maybe wonder how it's happening. Well, I showed you how it's happening 2 months ago. So stick with that theme or stay out until that theme is working. And that's, what Mark's doing. Mark's just basically keeping it light. And every now and then, if things start setting up, he bumped it up a little bit.
What about SSTK, Mark, as an example?
Yep, I remember that one.
I would call 4.9. It kind of worked out. You covered this in the video.
Definitely. Yeah, so that's 4.9 is definitely a pause pivot. Then you go outside the next day, but you wouldn't have known that on 4.9. On 4.9, exactly. You would have just seen it on that day, and that's an inside. That went inside, pause pivot. Next day you have an outside day, and then it breaks out on a gap. I think you bought this one, right, Mark?
Yeah, I did. It didn't really, obviously it did, worked and then failed, but this is where you had the undercut. You had the undercut of the low. They're around 79, kind of came right back up. If you were looking at this in real time, you go, well, there's not much of a pivot there, but it went really tight for one day and then just kind of hopped out.
Yeah. And I see that gapped and that got awake pretty quickly. I did not buy this. I let it go. Here's another. Now this would have been if I had gotten it, even if I paid up a little bit for it. I know Bob's going back here, but yeah. So that's the pause pivot, right? That's just that one day. But now go forward. If I had bought it the way I'm trading now, I'd been out of that thing. I would have probably sold some on the first day, and then that next day, bailed out of the majority of it. Now, right there, wow, that's a great pop right off the hop, right? And then the next day you get another one, but you get the reversal. But again, look at that 2-day move. I mean, if you're trading those in size, especially, you're making a lot of money if you keep getting these opportunities. And we've just got these over and over and over. But then they come in. Here's a natural reaction, comes back to the breakout point, right? And that's looking great. That's not looking great anymore.
Yeah, that was earnings.
Yep, that's on earnings. Of course, then it came all the way back. And if you were going into earnings, you see, again, knowing earnings are coming up, then again, you should have sold into that first move up and taken a piece off, so you would finance yourself going into earnings, and you had a cushion, which that's probably what you did, right?
That's exactly what I did. And if you look, though, even as I was saying earlier, this stock actually beat the earnings and they raised guidance, and the price action was lousy. So it's just, they're not, like you've been saying, they're just not, institutions are selling into this stuff, not buying.
Yeah, when things are working really good, stocks rally on bad news, and when things are not working, stocks decline on good news. So that's why you never want to trust the numbers or the story unless it's being confirmed by the price. The reaction to the report tells you much more than the report itself. I mean, if you're a forensic accountant, and your team of accountants that, you're or analyst working at Fidelity, yes, you're probably, understanding the numbers and what's behind them a lot better. And maybe you can go in there and buy when the stock's down because you understand the number. But looking at the chart and just going by reported fundamentals, you really have to let the response tell you whether that report is good or not. I've seen stocks blow earnings out of the water. Crocs was a perfect example. It's an example in my book. It came out with the earnings up 144%, and the stock's down 15% on the day. You sell, you sell everything right then and there. It was the biggest break that the stock saw since the beginning of the move on a weekly and a daily on the biggest volume. That's a major sell signal. And if you looked at the earnings report, a lot of amateurs, a lot of individual investors would be buying it, saying, "Oh, I can buy this, now at a discount, down 15%."
Just a quick comment I'll make on the question from Bob with the names on buy alert, some of the pivots not being so obvious. Bob, you got to make sure you read through the user guide, because just because a name is being put on buy alert doesn't necessarily mean it has a pivot point developed. And that could be exactly why some are not so obvious to you. They haven't yet developed into actually becoming viable.
Yeah, they're what's close. They're either close or they're viable. But they're trying to give you a heads up list of the stocks that are set up constructively in bases. It's really a sort of a heads up display to try to give you the stocks that are potential. Those are the stocks that I'm looking at as potential buys.
And his question, though, Mark, is a pivot point an exact number, or is it just a tight range?
I don't know what that means. It's an exact number. The top of the pivot
price,
point, the buy point of where it moves through, is an exact number.
Okay. Scott, from his prior question, is just following up with the typical drawdown using Mark's methodology. He's asking both Marks, what would be the worst drawdown you've experienced?
Again, Mark, how do we answer that? I mean, there is no typical. It depends on how quickly you're going to pull it in, and like, again, you get a bunch of losses in a row. What is your position sizing? How quickly do you scale it back? There is no typical. I mean, you can blow yourself up with this strategy. No problem. If you could stay in there and breakouts aren't working, and they set up and set up and set up, and you just keep playing them same size or bigger, you can rack up a gigantic loss. That's why you have to. Progressive exposure is, out of all the people that I've trained, and I think I said this a week ago or 2 weeks ago, when they come back and tell me the things that made the biggest difference, progressive exposure is like one of on the highest, the scale of the totem pole, is like the one thing that people go, wow, when I really understood that, everything changed. My drawdowns, my getting heavily invested in a good market, and I was able to make big money when I was right and minimize it when I was wrong. That progressive exposure is it's an elusive, or I should say, it's not an easy thing to fully understand and grasp the right way to use it, I guess. I don't know, Mark, I'm not articulating it very well. Maybe you can, you're one that has become really good at using that type of, scaling in and scaling out with real good success.
Yeah, I don't know that I understand if the question was, is there a certain number? And when you're new, there will be times where, you'll just buy everything because you don't know exactly how to do it. And if we have a period like the last few months, who knows how big the drawdown could get. If you're doing it properly, from coming out of cash, this is really where you want to say, I'll sit there and take, maybe 1 to 2, 3% of risk sort of I think of it almost like as a long campaign, like that's the way I think, where if I get completely back into cash and I get stopped at everything, I lost 2% or 3%. How many times am I going to do that before I get it right? And I take my 2 or 3% and turn it into 20, which is what I'm hoping, 20 or 30, 40, in a good 2-3 month period is what I'm hoping to do if I really nail it. So, yeah, I might take 3 or 4 of those in a row. That's rare, but 2-3%, 3 or 4 times in a row, that's totally acceptable. That's kind of how I think about it anyway.
Yeah. I was only going to add in there, just from, if you're following Mark's rules and you continuously shrink your positions when things are not working, I think it's 5 or 10% type of drawdown should be the maximum you should be experiencing if you're following Mark's rules.
Yeah, you get into double digits, you're really in the red zone, in my opinion. You want to keep it, single digits, low single digits, and then you start getting into mid to upper single digit. Now you really got to pull it in. I mean, that's where you don't want to start getting into double digit losses, and then you just work yourself back. That's the thing. If you bail out at, your total portfolio is down 2, 3, 4%. Now you say, okay, well, now I just want to try to, get that 2 or 3, 4% back and get myself back to buoyancy. And you trade light, and now you're trading lighter. So if you have another string, instead of going down 2, 3, 4%, now you might only go down 1, 2, or 3%, right? So you trade a little bit lighter than that. So it might take you a little time to get yourself back where you're back to even, but it won't take too long. It won't take that long. If things start turning well, you'll be surprised at how fast you can make up that little lost ground. But if you have a big loss, now you got a lot of work to do just to get back to even, and you're just defeating the whole purpose.
And don't try to make it all back in one trade.
No, that's the main thing. That's where you get yourself in huge trouble, where you start trying to trade larger.
Yeah.
And which I know many of you do, and you'll have to learn the hard way, but it can work from time to time. But when it doesn't, that's where you go deep. You go deep in the hole. And I know there's many of you that can relate to that. We all can relate to that. We've all done it. I don't do it. I don't do it ever anymore. It just doesn't, it's axiomatic. It's automatic for me to operate in a certain way. I'm never, ever loading up because I'm down and I start trading bigger and more risk. Never, ever will that happen, because I just know that just leads to disaster. Mark, is there any circumstance whatsoever, and any circumstance if you're getting clipped, that you start, piling in bigger and you start trading bigger size?
Never.
But I know there are people who are listening right now that are, and that's exactly what we're trying to emphasize to you.
There's probably the majority of who's listening does it.
Yeah, you have to have that big picture perspective, guys. You have to realize you can get out of it, but you just got to do it baby steps, step by step.
But you have to look at the downside. People always looking at the upside, so they're thinking about getting back to even. I tweeted this just the other day, but a friend of mine, and I certainly wouldn't mention any names to embarrass him, but a very close friend of mine called me about a month ago and said, my son wants to get into trading. Can you come and meet us for coffee, sit down and talk with him? I said, look, I'm going to give you my book, have him read the book, and tell him don't do anything until he reads the book and I talk to him. He's 24 years old. Never thinking for a minute that what I was about to hear a month later. So I got a text message from him yesterday, and he said, I'm going, my friend said, I'm going out of my mind here. My son lost $120,000. And what do I do? So I said to him, well, how'd you lose $120,000? How much did you give him? I gave him $200,000 to start. And this is not a real rich man on top of it. He gave him $200,000 to start. He put $175,000 into options on Tesla. And I guess he was long because Tesla's been drifting down lately. And he took $120,000 loss. But immediately, here's what he said. How do we get it back? Should we double up? And yes, that's what he said. How do we get it back? Should we double up? Like, that was his first response. Not how do I protect the other 80 grand, or, nothing about risk, all about getting it back. That's all he's thinking about, is how to get it back and get it back fast. You see, that And I told him, I said, well, if you want to lose it all, you can, and lose more money. Yeah, you can. I said, just stop. No options, no leverage. Don't do anything. And you know, you just gave $200,000 to a kid who doesn't know anything. Obviously that was a stupid decision, but yeah. So, but that's the immediate response, is to try to get it back and try to get it back fast. You got to get, because you're not thinking of the risk. You're not thinking of the risk. He's just all pissed off that he lost the money and he just wants to get it back, but not thinking that do you realize how upset you're going to be when you go down another 120,000 or you go down $500,000, you know, then
or worse yet, Mark, he makes it all back and reinforces terrible behavior.
Well, that was my very next sentence was, I was going to say, and then the worst thing that can happen is he doubles up, he buys more options and he hits it big and he gets it all back and he's at a profit. Now he's like, oh, see, that's all you got to do. I mean, you know, that's, I just double up. I just double every time I'm down. It has to come back. And now he's setting himself up for a complete, total disaster because he got rewarded for a bad habit. See, most of these people don't know what a bad habit is in the first place. So, and then they get rewarded for it. So now they think it's a good habit. And it's just, this is what's happening in this market now. We're setting up, there's a lot of young traders. I did a Twitter poll and asked how many years my average, you know, my followers were that they were trading. And this is with a couple 100,000 people, where I think like 10,000 or 15,000 people responded to it. And the most of them were 1 to 2 years that they were trading. So you've got all these, you know, these kids and these younger people and these newbies buying SPACs and all these names that keep coming back, and they're buying them while they're down, and buying Tesla and buying Amazon. Every time it's down, it comes back. And they just believe that's the way. You know, now the new saying is diamond hands, you know, means to never sell, you know, just double up, never sell. Though we're setting up an entire generation for the biggest losses that we've ever seen. That's what's going to happen. I will write the end to this story, and I will assure you that it will be correct. It's just a matter of time that you're going to see ginormous losses, because they're going to buy these stocks down and they're going to keep going down. They're going to keep doubling up, thinking they have to come back. And at some point, you know, these names are going to be down 70, 80, 90%, and they're not going to come back for 10, 15, 20 years.
Yeah, especially if that's coinciding with their retirement. That's going to be painful.
Exactly. And it's usually, it never is convenient the way these things work out. Your big losses always come at the worst possible time, it seems like.
Yeah. Well, that's actually getting close to our wrap up time here. So I think we're going to cut it off at that story, Mark, and leave people with that thought, and we'll pick it back up next week, guys. But keep the questions that we were not able to get through today. Obviously, with some of the stories and tangents and Mark goes on, we don't get to all the questions here, but we have next week to catch up on that. And this replay will be available in the next few moments. Keep in mind, again, we have a number of earnings this week. So watch the platform and the live stream for Mark's recommendations on how he's positioning with some of those names. And on that note, Mark, thank you for your time. And Mark, thank you for your time. And we'll get going here for today's session.
Thanks, guys.
Alrighty. Bye-bye.